Good morning, everyone, and welcome to this Kepler Trust Intelligence Summer event. My name is Thomas McMahon. I'm Senior Investment Trust Analyst here at Kepler. In a short while, I'm going to introduce our panelists and our panel discussion. But before I do that, here's a quick reminder of the plan for the day. So after this panel discussion on the outlook for the UK, we'll be hearing from Rory Bateman, Schroder British Opportunities, James Henderson, Henderson Opportunities Trust, and James Dupper of Edinburgh Investment Trust. And then in the afternoon, the focus shifts to small caps. We have a roundtable and three managers who will speak to us about their portfolios. So why are we here? Well, I just wanted to briefly highlight a couple of articles that we wrote 9 or 10 months ago on Kepler Trust Intelligence, which I encourage you to have a look at, where we win an incredible piece of analytical skill prescience, which nobody else had thought of, highlighted that perhaps the UK was looking a little bit cheap and it could be time to be increasing exposure. Why did we think that? Well, this is just a reminder of what's happened since the Brexit vote. So this is all in dollar terms. The FTSE All-Share is in blue, and you can see that it has considerably lagged its developed world peers. That's despite some rather good performance since the 1st of October 2020, again in dollars, and the All-Share is in blue. So this was more or less the beginning of the vaccine rally, or the reflationary rally, however you want to look at it. Why has the UK done so well in this short period? One factor may be the weighting to value sectors. So these from the most recent fact sheets, the weighting to financials, energy and basic materials in the FTSE 100, the S&P, the MSCI Europe. And you can see that the UK has roughly 40% in its large cap index in these sectors, which has clearly been helpful. Another way of looking at a very similar idea, but it's perhaps slightly different concept, is to look at cyclical and defensive exposure. So Morningstar divides sectors into sensitive, cyclical and defensive buckets. And on this way of cutting the market, you can see the UK has almost 50% in cyclical sectors. So whether you think value or cyclicality is more important over the last few months may determine what you think over the prospects over the coming months and years. So after this rally, the UK still looks relatively cheap, at least relative to its peers. So these are the 4P ratios over 10 years, and I've marked in the 10-year average there. The UK is again in blue, Europe in red, and US in green. And you can see that although all indices are above their 10-year average, the UK is very close to it, so it's much less expensive, at least relative to its own history. If we dig down one level further, I mean, it's maybe making too much of small differences, but I think arguably there's perhaps more opportunity in the smaller mid-caps. But the large cap index, you can see there's a clear distinction between the UK and its peers. So these are the 10-year Z scores from Bloomberg, calculated from Bloomberg, the UK in yellow. And you can see that UK large caps, although they do look ahead of their 10-year valuations on both price to earnings basis on the left and price to book basis on the right, they're still more expensive than recent history. But when you look into the mid caps, or again into the small caps, you can see that at least on a price to book basis, the UK still looks cheap relative to 10-year history. Maybe the price to book is a better metric to look at the moment, given turmoil with earnings due to lockdowns and various other restrictions. But in any case, as I say, maybe it's a small difference, but perhaps indicates that the better value is at the smaller end of the market. So I won't rabbit on much longer, but in conclusion, clearly the UK has had a really good recent period of performance. But it still looks cheap, not really relative to its own history, but certainly less expensive than other markets. However, that's maybe not a particularly strong argument for investing in the UK. Marginally less expensive than others doesn't sound fantastic. And perhaps with the relief rally looking like it might be over, if you look at returns from commodities and the major indices in recent weeks and months, certainly it seems like this is a good time to take stock and ask where is growth going to come from over the next few years, and does the UK still look like an attractive place to invest despite everything that's happened? So those are the disclaimers. You can all read word by word at your own leisure. So we're now going to hear from Rory Bateman from Schroders, James Henderson from Henderson, and James Dupper from Edinburgh Investment Trust. I'm going to kick off with a couple of questions, but please, this is for you to ask questions to the managers. So you should all see a Q&A box possibly on the right of your screen. Please do keep your questions coming in, and we will put those to the managers. We've got around 40 minutes, or a little under 40 minutes, so get those questions in early. So I'll kick off by saying, having looked at where the UK market is right now, perhaps there's still an argument to be made for it to be a value opportunity. But is that all there is to say about the UK? Is it merely a value market? What does it offer at this juncture? I think the fairest way we can go in alphabetical order to start. So Rory, what do you think? Is the UK just a value market? Or
morning, everyone. Thanks, Tom. Look, this is the start of a journey for the UK market, I believe, especially in the small and mid-cap space. To my mind, we've had multiple years of underperformance by the UK. So I do take your point on the recent rally in the market, and some of the really easy money, I suppose, has been made. But if you look at maybe look at a longer term context for the UK market, and we've been looking at a sort of average PE, price to book, dividend yield metric. If you look at the 30-year, in fact, you look over the last 30 years, we're trading on the UK on a relative basis, relative to the rest of the world, is at 30-year lows if you use those three valuation metrics. So this is very much the start of the journey, and we've had quite depressed UK market on the back of political and economic concerns around Brexit. We didn't handle the COVID thing very well at the beginning, I have to say, and so there was a lag in the UK market at the beginning of that period, and so we've seen a bounce back for sure. But to my mind, there are some fantastic growth businesses in the UK. It's a very developed market. We have excellent corporate governance. We've got exposures to international and domestic growth, and this is very much the start of the journey for me. And I think yes, valuations look a little bit richer in the short term, but 14 times for the FTSE small cap, to me it's a really attractive opportunity. And I repeat what I said at the time of our IPO back in November. This is pretty much a once in a generation opportunity to get involved in some really fantastic UK businesses.
Thanks. And James Henderson, what's your view on the UK at the moment?
Yes, no, I agree with that. It's an exciting time. We've just gone through a results season. And one of the things about last year was people had to look at themselves very hard. You ask companies, executives ask questions about themselves and about their business, and they focused on thinking what they did well. There was a desire for a reset in some businesses, and the costs have been lowered. And and a bit of top line growth, which is what we're seeing at a time of this real hard look at yourself, leads to operating margins grow. And I think in the short term, analysts are going to be a bit surprised by the strength of that operating margin expansion, and that will mean better earnings, and that's definitely driving share prices, earnings upgrades. I think in the more medium term, there are a lot of good businesses. Lessons learned in the last year will be lessons that will be very beneficial going forward for some companies. And that's exciting. The consumer is coming back, the corporate spend is coming back, and government spend on projects, on infrastructure projects is there. So I think all the ingredients there for for economic growth to surprise on the upside on a well-disciplined corporate base. There's no euphoria. There's companies I was seeing were trying to hold back. I was saying that surely if this is right and this is right, this earnings number the brokers are putting out, surely that's wrong. And you could sort of see them wanting to agree with me, but at the same time thinking, we've gone through a lot. We mustn't give hostages to fortune. And it was intriguing. There's no sort of euphoria. There is instead real discipline amongst corporates. We've seen quite a lot of change in managements in over this period, and the generation that have come through are. Having looked at the UK and worked at the same desk at Henderson's since 1982, I haven't seen the strength of the executive teams are the strongest I've seen. So at the same time, valuations, as Rory was saying, are not demanding on any long-term view, and at the same time, the economy is coming stronger. So yes, no, I think there are a lot of opportunities. We just got to make them count.
Thanks. James Dupper.
Yeah, well, I would echo a number of points that my co-panelists have said. And I think the things I would add is, if you think very simplistically about what share prices are about, it's essentially about supply and demand. And, quietly what we've seen over the last half of, the previous decade was a very big shift, I think, out of UK equities into global. And although it's more difficult to measure, I think the international investor is a very important swing factor, swing buyer, if you think about the demand side of that. And obviously, as your slides pointed out, 2016 was a big issue. There was a real sort of the UK was almost classed like Italy in political terms, if I could put it like that. And it was a sort of why bother type area. And obviously that is hugely rear view mirror now. We've got political certainty. More latterly, our COVID campaign has been sure-footed. And I think the international investor, we can sense, is coming back. So that's the point I would add. And you can see that in, for example, purchases of gilts by international investors at highs. Yes, that's gilts, not equities, but important. And I think it's an indicator that the risk premium associated with the UK equity market, having been at extremely high levels, is now falling and has a lot of scope to fall further. And then just to add to James's point, I think it's a really important point that actually COVID, for some, if you like, sort of legacy incumbent companies, and the UK does have a few for whom that epithet is associated. COVID has given them the opportunity actually to take black and white decision making. There's no room for grey areas in these decision making during COVID. And so the scale of cost and change in some of these incumbent businesses is off the Richter scale. And a lot of that will come through to shareholders. So I think we're in a good place. And as Rory said, I think it's, we're early days in that. Thank you.
I would just add a good point on the international investor base from James's perspective. We saw at the back end of 2019, when Boris got a massive majority, we started to see a pickup in the international investor interest. And then, of course, COVID hit, and we were one of the laggards in the COVID experience, you could say. And so we saw a sort of withdrawal, quite a significant withdrawal from an international investor base. And we're beginning to see that come back. And that's indeed what's been happening over the last 6 months or so. In fact, this year, in the first quarter, we've seen allocations to UK equities back to sort of pre-Brexit levels. So confidence is returning, and that international investor base is going to be critical for the momentum that we're seeing and a continuation of what we're talking about now.
And one question from the audience maybe picks up on a similar point. So we've seen perhaps a number of opportunistic bids, is the phrase used from private equity in the UK market at the moment. Is that frustrating for the participants? You know, seeing these opportunities taken away from you.
It is. It undoubtedly is. Usually in an upswing, the early deals are the ones that are best for the corporates buying, and I think that's what we're seeing. Towards the end of an upswing, corporates pay too much for companies, but at the early stages, often the best deals are done, and I think we're seeing that. There's a huge, as the charts are showing, you know, there's this big difference in valuation between America and the UK at the moment, and that is an arbitrage that some of these development capitalists are using. So I think we have to fight hard not to sell out too cheap, particularly some of what are deemed as old economy type businesses, because in the valuations of them are particularly low. So fight hard, and that's what I'm saying to management. You know, don't. Yes, you have to show shareholders if you think the bid's worthwhile, but let's keep fighting. And I think things like Senior turning down that approach the other day was right. I think over the next 2 or 3 years, that the focus a bid brings to management is also sometimes useful. You know, you have to show how you're going to justify that price in time, and then go out and do it. And those aren't bad disciplines. So I think the interest we're seeing underlines the value that's out there, but it's also we mustn't be selling out too early.
Yeah, I mean, I think if I could add to that, you know, if we take a long perspective, you know, it's sad you know, the long list of companies that have effectively been ripped out of the listed environment. And if we think, you know, where we are now, we're obviously exiting, you know, in a slightly checkered way, but we're exiting the COVID period. And you know, for incumbent management, this has probably been an incredibly exhausting period. And so, you know, it's probably unsurprising to see, you know, the odd corporate go. But, you know, I would definitely say that, you know, our premise at Majedi is that companies should remain in the listed environment unless there is a very compelling offer, and it has to be a very compelling offer for us to be interested in these sort of instances.
I think just I'd agree with the comments. I think from our perspective, we have viewed the launch of this fund as a very much as a 50-50 public-private offering. So we are treating every case individually, as you might expect. And I agree with the previous comments in the sense that we're very big proponents of the listed market. We've been very vocal about that in the media. The other thing, of course, is that we're very active against unfair bids, and you know, we were the first group, for example, we were very vocal about that. So we tend to treat every case on its merits, obviously, and the purpose of having a public-private vehicle is to exploit opportunities on both sides of the equation, and we don't really care actually about the ownership structure. It's more about the individual companies and what is a fair price for that business as we see it at the time. So I'm slightly nuanced in this, given that we're both public-private and we're very open to opportunities on both sides of the spectrum.
We have a couple of questions from the audience. Apologies, Rory, could you pick up on me? A couple of questions from the audience talking about mega cap growth stocks in particular, or certainly technology stocks, and why the UK hasn't been able to grow these businesses. And I suppose that picks up on what we're discussing now, and that one of the elements presumably is giving away the business quite early in its life. Are there any other reasons why the UK hasn't grown any of these mega caps? And maybe broadening it out from just tech, I think James Anderson, in one of his valedictory interviews recently, criticised the UK market and saying, you know, it didn't really have a strong enough entrepreneurial culture. It didn't really have enough long-term vision. And do the panelists think that the UK is going to grow world-leading businesses again, or are we going to remain a market filled with, if you like, relics of the 19th century? I think was the phrase.
I think that's very hard, tough thing to say about the UK. I only have one unquoted in Business Opportunities, and that's OSI, and that's Oxford Science Innovation. And in that portfolio was the company that with Astra has developed the jab that many of us are getting, and it was the first to market, and it's a huge fillip to UK science. There are companies like Ceres and ITM that are really making strides in the defossilization by providing alternative energy and they are world leaders, and German companies, Linde's, for instance, tying in with ITM, or Bosch is tying in with Ceres, because they're needing UK technology. So I think it's a myth. There's a lot of very great technologies out there. Yes, it's true that some haven't been developed, but that has been about the UK in recent years. It has been a cyclical, difficult place sometimes to operate for various reasons. That some of those companies are now coming through. License models mean that the amount of capital required for them isn't as great as it was. But yeah, there have been failures in the financial system at supporting these companies. There hasn't been a failure of science. And the UK has got a tech sector. It's just that it's not fully represented in the stock market. Even within the stock market, something like British Aerospace, which is deemed as sort of value stock, there's so much good science in there. There's so much good technology in there. Flying drones from Barrow all around the world. It's real tech. It's just not hidden. It's not in a tech sector. It's an industrial sector. So no, it's exciting, and the speed of change is huge at the moment. And the UK is up there in many of those leading areas, whether it's the pharmaceutical sector or it's the defossilization of the general economy.
I think I'd agree with that. There are some amazing businesses, fantastic growth businesses in the UK. It's fair to say that the US have been far more successful at incubating, providing capital to younger technology businesses. A lot of that has been in the private space. We've obviously companies are coming to the market a lot later in their development, as you can see from the IPO. Some of the mega, really large technology companies in the US. And Lord Hill's review, if you read that, it basically is it's a recipe for how we can improve our positioning in the world with regards to funding and making changes to the UK market. And I think we as a country have real fantastic entrepreneurs. We sell out too early, because when you've effectively got free access to capital on the west coast of the US, they can pretty much suck you up pretty quickly, very early in your development, and it's almost criminal from a UK PLC perspective. So I think we've got to do more, support Lord Hill in the reviews, and get more dynamism within the UK market. Having said that, there remain, as James has said, some fantastic business in the UK. For example, in our portfolio, we've got a company called Rapid. It's the world's largest local payments network. This is a big, fantastic global fintech company, listed or operated out of the UK, and it's you will have heard of Strike in the US. It's got comparables to that, and no one's ever heard of it in the UK. So there are some really great businesses. Number of people in the market won't have heard of them. They're coming up very strongly in the private space. What we've got to do is facilitate that growth in the public arena as well.
Yeah, I mean, I think the emphasis in the UK really is often on clever use of technology, and that from a shareholder perspective can produce some good, durable, long-term growth. And companies like Weir, which have very strong, effectively mining technology, assets, and to do mining now, you need to use AI, you need to use all sorts of technologies to reduce the use of energy and water, and that's the sort of thing Weir does, or companies a bit further down the market cap spectrum like Essential, which is into e-commerce data analytics. I mean, yeah, I think quietly we have more than we admit to in terms of a technology signature, and so I would say don't write off the UK in that respect personally.
And James, in your original comments, and you highlighted the sort of the unwinding of the Brexit discount, if you like, or the risk premium, if you prefer. Do you think that can we put Brexit in the rear view mirror now? Is the path forward set? Can we start thinking about other things, or should we fear a rerun of the various disputes around, for example, the Northern Ireland Protocol? Could anything derail current situation? And secondly, would you say that is it possible to see some opportunities in Brexit, maybe in smaller companies or elsewhere? Are there any opportunities that are investable as well as threats?
So I think the big feature is that the UK, by virtue of language, time zone, rule of law, etc., has over the decades been a big beneficiary of foreign direct investment. Okay, obviously that hit an air pocket around the Brexit period. And to me, one of the seminal moments was when Nissan decided to reinvest more money in things like the Sunderland plant. Why I say that is, the Japanese have they measure their time frame in decades, okay? And that said to me that FDI is back, and that's a really positive aspect for the UK. Now, the reality is all we've got is a thin deal. The sausages thing, is in the paper today. There are going to be lots of these little things, and the problem is for small and mid-sized companies, it's a real headache dealing now trading with UK, Europe. So I would say we've still got a difficult period to work through, but the broader long-term perspective on which companies invest in, and that's the important thing, on which people plan for. I think we're through that, and people are beginning to look up rather than look down. So I just feel Brexit is in the rearview mirror. It's not a reason to sort of mark the UK equity market down now. And that's the key feature. There's going to be a lot of noise still on Brexit. Relations are not cordial. We all know that. But the big perspective is it's not the suppurating sore that it was from a business perspective.
I think that's right. There will be winners and losers out of it all. There will be, for the aggregate economy, I think it's still a bit of a drag. But you have to remember, with a fund, you're not buying the economy, you're buying specific companies. And some companies with their management teams, it's not going to be an issue. With some areas, it still will be. And I don't know what that means overall for the economy as regards growth rates in the medium term. But that's not what the job's all about. The job's about individual stocks and companies, and some will, whatever, politicians always mess things up. Companies sort them out, management sort them out. And we need to be with the managements that are sorting things out and let the politicians rant and rave.
It strikes me that, yeah, we're whenever we talk about Brexit, we're accused of looking through rose-tinted glasses, aren't we? But it strikes me that, as we talked about before, in terms of the overall market valuation, there's still a fair amount of Brexit doom and gloom priced into the market. And from here, let's think about the blue sky, the upside. If we have the ultimate more of a free market experience for the UK economy, that makes us gives us much more dynamism potentially going forward than we've had maybe over the last however long we've been within the EU. So it does put a new dynamic into the UK economy. I agree with James in the sense that there's going to be short-term, smaller issues that will hit the headlines. There's no doubt about that. But again, agreeing with James, the second James, it's about individual companies, and those individual companies that can exploit the new dynamic environment from a UK perspective will absolutely flourish. And that's not just domestically, that's internationally as well.
So in my introduction, I highlighted sort of the large weighting to financials, energy and basic materials in the UK market. I think at least two of those sectors have got some serious issues. So the banking sector, you can argue, sort of increasing regulation and a sort of permanently lower interest rate horizon means they're becoming less and less growth businesses and more almost like utilities. The energy sector clearly has a lot of pressure coming from net zero commitments and so forth. Are these big value sectors, do they have a future, or are they value traps?
Shall I kick off on that? So big questions there. I'm just taking each of those in turn. I mean, I think both of those have good prospects in terms of the sort of the top down, and we're very much stock pickers, but I think the top down in both these instances is quite important. If you think about what we're seeing in terms of the shape of growth, it is the policymakers are driving the economies hard, high pressure economies. Why I say that is it leads to quite an energy intensive shape of growth. The greenification and the like is going to require a lot of, frankly, a lot of energy. Trucks, copper, etc., etc. I think also there is a risk, and the Haldane speech, yesterday alluded to that. There is a risk that inflation, at least we begin to fear, overshoots a bit more than just being a transitory issue. Now, both of those things from a macro perspective are quite helpful for both those two sectors. But delving into banks first, your point on regulation, I would say that, the banking sector now is very well capitalized. There's a lot of muscle memory in terms of the valuation of the banking sector at the moment, but we're about to enter a phase where banks are about to start to be able to disperse decent dollops of capital to shareholders. In terms of the structure of that industry, what I think is quite interesting is the actual challenger banks, which have been a big thorn in the side of the incumbent banks. I think they've had a very difficult crisis for all the obvious reasons. And also the regulators, interestingly, have actually asked the challenger banks to have business plans that lead to profits in the near term. So now the pressure's on the challengers and the incumbents. Coming back to what I was saying earlier, I think the incumbents, and we all notice how many bank branches are closing, the incumbents are really using digitization. If you think about what's happened and how all of us use our banks over this period, it's changed enormously. And that obviously massively cuts the cost for a bank in terms of dealing with us, as well as also the net promoter scores for banks has gone up enormously. And to me, one of the big seminal things I've sort of read over the last sort of period was, I thought it was fascinating that NatWest Group, the old RBS, in their last but one statement, I think it was, signaled that they were looking to pay out in either a combo of ordinary and special dividends, a minimum of £800 million per annum over the next 3 years. Now, for them to put that in the statement, that has been signed off by the regulator, and you're having a degree of visibility in that one that actually is sort of very different from what I think the consensus expects, and the valuation is low. So yes, there are a number of risks in the banking sector, but I think it's wrong personally to write them off. Then in terms of the energy sector, it's difficult to generalize, but I mean, I think that a number of the big international energy companies that we have listed in the UK equity market, get very seriously the need to transform and transition their businesses. And the current commodity deck, oil price, LNG price, etc., gives them quite a lot of flexibility to do just that, because what you're doing effectively is, with these very high oil prices, you've got a lot of cash coming through, some of which they can return to shareholders and buy back shares, and some of which they can invest in their renewable projects. So what you're likely to see from these international energy companies, you're on a sort of 5-10 year view, is a very different shape to them. And these international energy companies, they're businesses with 100+ year histories that are used to dealing with change. They're used to changing. They may not change very fast, but they're used to changing. So I'd say, in both instances, I think it's wrong to write them off.
Great. Is anyone else want to? James?
Yes, the bank sector, those numbers that James went through are very real and come through. But in the medium term as well, there's been management change at the top of these banks. They are more dynamic, and they can be growing financial services companies under that bank, under that banking license. And that means if they do, and they go down that path, I keep being told they're becoming branches of the civil service. Well, you should see some of these managements, younger managements in some of these banks. They don't see themselves as civil servants. They see themselves as selling financial services to their client base, and you're able to buy them at below their book. They're getting a reasonable return projected on their capital going forward on the traditional businesses. And then you've got the chance that the financial services bit grows amongst some of them quite quickly. And that's quite a cocktail to not write them off. I know investors are skeptical, and quite right. The last 12 years has been a lesson in that. But there are lessons learned, and actually that re-emergence of a more entrepreneurial culture in some of the banks is exciting and should benefit shareholders over time. On the oils, I agree with James. They are transforming as companies. That said, if they don't invest in their oil businesses enough, the price of oil will go up and stay up. We're not going to transform to this away from fossil fuel fast. There will be this big gap, and the returns that could be made in conventional oil could be quite large in 5 years' time if people don't invest enough in the area, and the signs that might be happening. And therefore, some of them quietly will, on the bit of the portfolio they won't be showing us talking so much about, could be making very good returns in 5 years' time in their traditional businesses. People can overreact. We don't get to alternative energy in the very short term. Those targets out there will probably be missed, but still people are going to have to stay warm at night, and we're still wanting to explore. The young are still going to want to explore the world. So oil prices, I suspect, stay higher as a result of what's going on for a bit longer than people think. At the same time, absolutely, we will be moving to a world that moves away from fossil fuels, but on that shorter time horizon, we could get quite good returns from these large oil companies.
I think from our perspective, we're not investing in large cap companies. So I'll just make a generic comment. I think there are some amazing opportunities in the large cap space from our perspective. But the key word is transition. If whether it's energy companies or whether it's financial services, the transitioning of these businesses, some of which are incredibly large bureaucratic organizations, if they fail to make the transition towards the new economy, they will continually be attacked by the disruptors, and they're the businesses where we're actually more invested in and within this fund. But we've got to be cognizant that, as James just alluded to, this is a new paradigm. Whether we like it or not, the market valuations of these companies will continue to reflect the fact that the millennials and the next generation and the next generation after that will be continually obsessed with the fact that we can't go on destroying the planet. And so what the market pays for these businesses is going to be continue to be under a significant pressure. Obviously generate huge amounts of cash. I hate to say it, but some of them will go by the wayside into private equity hands probably, and they will be run for cash very profitably. But the nature of market, stock market participants, as we go through our generation into the next and thereafter, it's going to be very tough for these companies to maintain significant multiples on their stock. So I think we just need to be careful of that. There will be some that do make the transition, don't get me wrong, and they will be the winners. And again, it comes back to stock selection.
Fantastic. So we've got roughly 5 minutes left. So we'll go to a rapid fire format, if you like. So I might address a question, a final question to each individual panelist in the interest of time. So maybe James Henderson. So one question from the audience is surrounding yields. Do you think that the UK will remain a high yielding market, or should we expect over time it to become more focused on growth and present yields closer to that of the US?
I think Rory's answer to the last question has relevance to that. There will be parts of the market that generate a lot of cash that it'd be good if that cash didn't burn a hole in the executive's pocket and then go and buying things they don't really understand. It'd be much better that it's distributed as dividend to shareholders. That would be one part of the market. Another part of the market will not be paying dividends, I expect, because they will be needing to reinvest in their business to move it forward. And I think overall package can still give the UK index a reasonable and growing dividend, but I think the disparity of yields is going to open up. So things won't all yield 3.5%. We'll have things yielding considerably more than that and zero. So no, I still think the UK market would be a good place to have dividends. I like the discipline for some companies of paying dividends. It's easy to sit with cash, and usually if you have too much of it around, you find a way of wasting it.
Thanks. James Dupper, so picking up on one of our recent questions, one of our audience would like to ask you about the insurers. So they've picked out Direct Line, Phoenix, L&G. So they seem to offer secure income, but do you consider these to be value traps?
So no, and I'm going to focus on just Legal and General and Direct Line, because those are the two I hold. In both those instances, these are businesses which throw off relatively reliable dividend. You're looking at relatively low capital growth, frankly. But in both these instances, they have strong comparative advantage. So in the case of Direct Line, yesterday they had a claim seminar, and the questioner can go on the investor website and look through the slides. But what is clear from that is that they have a comparative advantage in managing claims costs, and that is a key competitive advantage which underlines their comparative advantage over time. Legal and General, different comparative advantages, but certainly has it. And those are the things that underpin what are quite juicy and outsized yields. So I do not think they're value traps, but they are not companies that are going to, produce very strong capital growth. They're more income stalwarts.
Thank you. And Rory, finally, as you look at opportunities right now, do you see greater attractions with domestic earners or overseas earners, or is it very much a case-by-case basis?
Yeah, I mean, you might expect me to say this is very much on a case-by-case basis. We make no apologies for being out-and-out growth seekers. I think that the opportunities for cash returns in certain segments of the markets, as James has just alluded to, will be very relevant for many investors in the UK market. We still need cash, we still need dividends, and that's for the good. We're not focused on dividends very much at all. We like cash generation for reinvesting in the business. We're very much open to funding new businesses as we grow the trust, and that's really the purpose of the vehicle, is to fund domestic and international businesses. We've got a very UK focus to the fund, and we believe that we can provide capital to help grow those businesses going forward. But if they've got an international opportunity in order to facilitate or enhance that growth, then all for the better. Brilliant.
Well, thank you very much to all our panelists. Personally, I found it very interesting, and I hope that you and the audience did too. I have studiously avoided asking the first question that came in, asking the participants to reveal a favourite stock, because I feel like that will be stealing the thunder for their presentations later on in the morning. So I'm afraid you're going to have to hang on to get your stock pick ideas. But yeah, thanks once again to panelists and to the audience. As a reminder, Rory will be joining us again in roughly 15 minutes to talk through Schroder British Opportunities. James Henderson will be joining us at 11, James Dupper at 12. And yeah, thank you once again, and hope you enjoy the rest of the morning.
Thank you.
Bye. Bye.